Hello everyone, how's it going? In this video, we're gonna do an update on Mullen, trading under the ticker symbol MULN. So Mullen is an EV manufacturing, distribution, and marketing company. Basically, it is a company that tries to make its mark in the EV sector. It acts as a holding company for several brands and companies they may want to buy along the way. The latest one is a company called Elms, and it makes EV trucks. So the company began the current version of Mullen began around 2014 as a successor to a company called Coda Automotive. Another company called Mullen Motorcars was also founded in the beginning of the years 2000, and they came out with Mullen GT, one of the earliest EV supercars in the market back then. So overall, it's fair to say that Mullen has been an EV veteran. It's been around the block for a long time. So we can give it some credit for that. The question is whether they have the means to continue the long game. And in fact, speaking of long game, we may not be in the long game to begin with, but we're going to talk about this in just a second. So the recent price action has seen Mullen share price reaching around 36 cents, down by about 35% compared to the peak of the stock. Well, by peak, I mean like the recent peak of around 55 cents. This price movement would be particularly bizarre if we take into consideration the latest news from the company itself of reducing its debt by approximately $13 million. The actual reason why the stock might be down includes the recent interest hikes, like the overall negative market tendencies, the fact that many shareholders may want to realize their gains in order to exit their position because they were overexposed previously, or the additional short pressure that has resumed in order to make sure that a short squeeze doesn't happen. So there are some speculative reasons about why the company is doing poorly at the moment. But of course, we cannot say for sure what causes the stock to behave the way it did. But overall, I would say that it's been mostly a bearish 3 month for the company, and in fact probably a few years if we are at that as well. So the stock has been over the past 5 years trading between $5 to $10 and then peaking around $15 before it finally fell in the penny stock level over the past few months. So online communities along with media outlets are both apprehensive and skeptical about the recent price movements of Mullen. So some of them are saying, could this be a great EV company in the making? A lot more are saying, it's better to stay away from it because we don't know what's going to happen. And I mean, to all these, I would say fair enough, right? Because it's better to be careful in this kind of market. The probability of things going sour is kind of higher than the probability of things going well, unfortunately. And again, because of how everything else is doing, because how money tends to go to security in this kind of context, where if you don't take any sort of risk or barely any, you're going to enjoy 5 to 6% of returns, which over the past decade or so has been a very good investment, like a very good investment yield. So given all this, they don't have to take a huge amount of risks, put these things into put the money into EVs and so on. So this is also why the demand hasn't been the same compared to pre-2021 or 2022 kind of demand levels. So the online community at the same time is kind of uncomfortable with the periodic lack of transparency, like not disclosing important information about their clients and their suppliers. For example, recently Mullen said that, we're going to work with a Fortune 500 client. They never disclosed who that client might be, and they clearly stated before that, we're going to definitely say it, and they didn't when push came to shove. Another example would be, how recently the reason why this theory that maybe Mullen could go through a short squeeze was because they got a contract to distribute iGo in Europe. But see, iGo are small vehicles. They're small, cheap, compact EVs that are more made for like food deliveries and parcels deliveries. It's all good, except we don't know who made this car. We have a feeling that's certainly not Mullen. In fact, we have certainty that it's not Mullen who made those cars. And right now, it's probably going to put on its own like trademark and reputation in stake for this project, right? So we don't know how it's going to go. We don't know how much cash it's going to incur. What we do know is that finally there might be some much needed operational cash flows coming in. So that's all we know. And the other thing is it has kickstarted like the momentum, a positive momentum over the past few weeks that we are seeing now like kind of waning away. But we don't know how things are going to exactly go just yet because things are still very much like work in progress. So overall, I have to say that Mullen does give us the impression that a company is good for trading, it's good to create volatilities, but whether it's good for long-term holding is in the eyes of the beholder. If the beholder were me, I would say that, it's maybe not the best time to start thinking long-term with Mullen just yet. In fact, as far as the stocks go, if your plan is to stick into the equities market, now is not the best timing to start buying. Sometimes I do have the feeling that central banks around the world, in order to quash the inflation, they're going to go up in the interest rates. But if the inflation is caused by real world events, then I wonder, how much of an effect increasing the central bank's interest rate is going to have, if any, other than creating or forcing the occurrence of a recession. We don't know this yet, but it's certainly not helping. So anyway, the point is, Mullen is good for short-term trading. Long-term investing, we will have to see whether next year they're able to roll out new models, and or if iGo cars are marketed and distributed with success in the European market, which is possible. I mean, the thing only costs 12,000 euros. If you want to kickstart your own little Amazon delivery business, then this might be the way to go. Or if you want to start delivering food, this might also be the way to go. But of course, the counter argument is, yeah, but you can also do it on a bike, right? So the trends within the EV sector, if we take a look at that, well, things are still looking challenging, to put it nicely. The main thing to look at would be how Tesla has been doing recently, and Tesla has been going from lower peaks to lower peaks over the past few months. So this is why I think that the entire sector is a bit soggy and sluggish as we go forward. What we also know is that there is a phenomenon of capital flight back to their normal sectors. Like, what I mean by this is, back in March 2020, when the whole world economies began to shut down, markets around the world plummeted. And what a lot of capital did back then was to go into like EV sector or growth stock sectors. And this is why we saw the amazing bull run from 2020 to part of 2022. But given all this, it also means that the capital flight inward was kind of abnormal. So now things are kind of going back to where they should be before this flight began. Now it's going to like safer options, blue chip stocks, and whatnot. So the additional concerns would be the supply chain issues, the shortage of key components, the valuation model of EV companies, if they might be valued from tech companies to car companies, which makes a huge difference actually, because car companies are industrial manufacturers, whereas tech companies are, Silicon Valley style tech companies, and then their market cap tend to be very different. Now, there is another reason why Mullen, for me at least, has been an interesting stock to follow. It doesn't always follow the trend. It hedges some of the sector-wide risks. Now, obviously, this is on some very relative basis as the recent price action suggests otherwise. So let's take a look at the financials. If we look at the cash balance, based on like the quarterly reports, it has increased year on year and decreased somewhat in the recent month. So overall, it's not really a big issue. It's not suggesting that they would have to forcibly go through another round of dilutions or to take on more debts. So this is a good thing. On the other hand, the liabilities, and see, this is like the big news over the past few days. So basically, Mullen has been able to pay back more than 10 millions of its liabilities. In other words, its balance sheet now looks better, right? It's more sustainable for the future. If they have less debt, it also means that they have less obligations of cash outflows. It means that they have less of a risk of going insolvent. But the share price actually fell since the beginning of this week. So this probably shows us how the market is not always taking into consideration the company-specific fundamentals and puts a lot more importance on the overall trends, like the surrounding economy, like the mentality of what people do when they are in this kind of environment, and probably not like they either take money out of the stock market because in recession you want to keep your money closer. Now, if we look at the profitability, so currently without the IGO distribution contract, we still have yet to see how that's going to go. There is no revenue that's been booked since the beginning of 2021. The research and development increased significantly with general expenses down. So overall, it shows that Mullen knows how to control the losses. Well, sorry, not the losses, but like the expenses. They're trying to keep tabs on everything. They're trying to not spend their cash too quickly, so on and so forth. And when they spend money, they want to make it count by like prioritizing the R&D, supposedly. So all these are hopeful situations. Hopefully, like I would say that hopefully the contract with IGO distribution can alleviate some of the concerns, because even though they're not losing a huge amount of money year in, year out, at some point this is going to start to add up. And overall, I have to say that if Mullen runs out of cash, they would still have to go through different rounds of like capital raise. And I don't think that they want to take on more debts, because debts you have to pay back, whereas equity is a promise of paying back. It's not. There's a huge nuance into this, especially in the earlier phases of a company. So overall, the financials of Mullen shows us that the company is doing its best to keep tab on things, to control its cash levels, and to keep the expenses down. But still, at the same time, the positive cash flows still needs to happen sometime in the future to avoid dilutions, delisting, and further going concern issues. So what this means is that they need to start making money either by rolling out models or by doing the distribution deals with clients. In terms of its clientele, I would say that it's mostly similar to like the mid to low range version of Tesla, because it's mostly for sedans and SUVs. They're currently priced around 55K, which is acceptable for an SUV car, especially EV. But the IGO distribution deal also makes available like smaller cars, compact cars that are made for parcels and goods deliveries. And this is also an interesting route to go, because we already know that with the advancements of technologies, nowadays when freelancers want to deliver goods, they want to use like electric vehicles or hybrids, because they're getting cheaper and cheaper, and also they have like far better fuel consumptions. So overall, Mullen is an interesting mixed bag of good and bad things, that makes it an attractive company potentially for like trading. So a quick description about the shareholders. They're mostly retail, they're volatile and reactive, to any significant price action movements or the mood in the market, which is also why Mullen is good for trading, but not really for investing. There are also some institutional shareholders, and their numbers, last time I checked, was increasing. But it's still not significant enough, in my opinion, to make Mullen something I would stick my money into it for like more than 12 months. For now, it's not happening. Not yet. So at the same time, the lack of significant institutional participation means that there is little trust coming from the institutional side. But of course, it's not always required, it's not always a must, just one of the things to think about. The risk factors are still like the higher interest rates, the VIX number, meaning the fear factor in the market, the money supply situation with quantitative tightening, the absence of like quantitative easings around the world, and also the fact that the inflation kind of sucks money out of the equities market, the bonds and money market in general. So does Mullen have like some advantages over other companies? Yes, like we've covered before. It's not always, it doesn't always correlate with the major trends, although it kind of is now, right? So this is, I would say, half pro. The cons would be the lack of transparency and the fact that this company has suffered significant dilutions. They may actually run out of time, to be honest. Like if we put ourselves into the scope of 5 to 8 years, do they really have 5 years ahead of them? I would say that things need to happen for that time to be provided. Otherwise, it's really hard to say. But you see, and here's the thing, we don't need a company to remain prosperous in the long term in order to trade the stock. Because one of the biggest reasons why people trade Mullen is because they want a short squeeze Mullen. There's a huge amount of short orders and short positions from like institutional shareholders or they're not shareholders, but from institutional traders. And the fact that if people pile in and decide to drive the stock price higher, many of them would be forced to redeem. And if that happens, then we can definitely expect the stock to go up by like 100%, 200%, 300%. Why? Because the way that short squeeze works. Short squeeze doesn't require any company's fundamentals, because otherwise we can pretend that in this day and age, when people buy most of their games on like online platforms, there is still some relevance for companies like GameStop that exist. You see what I'm saying? Like, we all like GameStop, we all dislike people shorting it, but it doesn't mean that its business sense still makes that much of a sense in this day and age. Same goes for Redbox, same goes for AMC. I can't recall the last time I went to a movie theater. I think it was in 2021. And also the other thing, like, I'm pretty sure that the last time I rented a DVD was like 10 plus years ago, right? So it's not always a good business model, but it doesn't have to matter. And in this case, we're just saying, are the people long the stock powerful enough to force the redemption? If we can do this, then really sky's the limit. And the longer this drags on, the longer those short positions remain open, the more financial fees the people having those positions would have to pay to the brokers. So yeah, I would say that a short squeeze play is the biggest reason why people may want to invest into Mullen. Now, the big question is this stock for you? Is it good for you personally? So if you're comfortable trading small amounts of penny stocks as marginal positions that could spike, then I would say that this could be something to think about. If you're comfortable trading very volatile situations, if you can afford to lose significant chunks or all of this position, then, be my guest. I think that this is a play that is worth the risk, the controlled amount of risk. I would suggest to first look for some short-term support, meaning if you see that the price was able to stop at a certain level and then it just refuses to go even lower than that for the rest of the day, if that ever happens, then we may have something. And then that could be a good entry point. The longer it holds, or the longer the holding and the recovery lasts, the more convincing that this is an entry point and this is the bottom, at least in the short to medium term, will become. So overall, my recommendation would be to start looking now for possible entry points if you fit the profile and if you're comfortable trading volatile titles in this kind of environment. Personally, I do have a position. For full disclosure, I do have a position in Mullen. It's a position that if it goes all the way, it's not something that I'm going to cry about for very long, because my passive income will be able to just plug this hole entirely. And personally, my strategy is to dedicate about 0.5% of my portfolio's capital in Mullen and to hold it for 3 to 5 months, give or take. It could go to 6 months if needs be. So yeah, I would recommend to commit a maximum exposure between 0.5 to 1% of your capital. Now, given the current market environment, I believe that the equity market is in a vast phase of correction, especially when it comes to tech and growth type equities. The financial market has been living and breathing thanks to the continuous creation of new capital, with different waves of quantitative easings, which will have consequences on the price of assets as well as their yields. With the interest rates kept relatively low over the years and the increase of amount of capital in circulation, this will keep putting significant pressure on the profit that we can expect in investment products across the board. And this, by the way, is a reality that may shift in the years to come if the interest rate of core infrastructures within our globally financialized system increases. It's useful to remember that the market doesn't represent the real economy, and of course, the real economy doesn't always reflect in the stock performance, since the name of the game here is ultimately called supply and demand, which depends on a whole bunch of factors that go way beyond our own control. If we think about it, this is like saying, if your neighborhood house that is put up for sale is only allowing those who actually want to live inside to buy it, versus if you allow every single type of buyer with different intent or reasons to buy or to sell it. So obviously, there will be a significant difference in the price of this asset for those two scenarios. The market currently works more like the second option, and assuming that it would only reflect the fundamentals of the underlying economy would correspond to the first option. There are a few elements that are considered to be the reasons. The first one is the significant increase of amount of money printed by the central banks around the world, which is then distributed to the banks, with the expectation that they will be loaned to businesses. Normally that's a good thing, but with a lack of opportunities in the real economy, the significant portion of that money actually went back to the financial system to buy up the price of existing assets. Now that the QEs have been wrapping up, or ended around the world, I think that this drive behind asset price may no longer be as relevant as it is right now for the future. It is now compensated by the arrival of capital from one region to another, and from one sector to another even within the same jurisdiction. With the increase of tensions around the world, capital is always looking for a safe haven to park their money into, not just for a place to grow the nominal value, but with a currency that tends to keep its purchasing power as well. The third factor is the creation or the birth of artificial bubbles, either maintained by the market trends built up over the years or out of necessity. Capital needs to find a place to stay. Some good examples of this would include the EV sector in the 2020 and the oil and gas securities when there are tensions around the world. Either way, When it comes to the price trends of the market, degree of uncertainty is a key drive behind the price fluctuations, and that is likely going to increase as we go on from there. When companies announce that they are going to enter or exit different markets, or that they will be trading on different platforms and exchanges, this can all have significant ramifications on the price of this asset. Some of the considerations to have when operating in this context include having a clear view of what is going on, especially regarding the cash flow and the capital flow, and avoid certain potential pitfalls. One of these is to be careful with short positions. Inherently, short positions are riskier than long positions as the downside of long positions is limited, whereas the short positions can lose you as much money as the stock price may reach, which is infinite. On top of that, we're now seeing a new phenomenon with short squeezes, involving a group of retail traders propping the stock price up, forcing short sellers to recover their positions. Sometimes the attempt will not succeed, but sometimes they end up in very spectacular success. Something else to consider is to treat tech stocks with care. To start, ask questions when the price of a security skyrockets without real fundamentals. It doesn't mean that you shouldn't be touching it with a 10-foot pole, but it does mean that there should be a difference between the decision of long-term holding and short-term trading. Either way, a rule of thumb is that each position should be structured in a way so that their individual performances will never affect the portfolio's stability. Thank you for watching. If you like my content, please like, comment, and subscribe to my channel.